Good morning and welcome. Patriot Radio News Hour. Joe and Jason here on this Tuesday. I hope it finds you well. The heat is on. The heat bubble over Texas is now spreading. I guess I don't know how it spreads. I don't know about weather, but it's summertime. It's going to get hot. Oklahoma, Kansas, all these places where we say we need rain, not going to get it here in the Valley of the Sun. It's been a great year. It really is. I was saying to all my friends, hey, if this was what global warming is, yeah, I want it, right? Because it's been that good of a year weather-wise. That's over. That is over. I'm hearing 115 degrees this weekend. So everybody get ready because the heat is on. I know everyone that lives in those places wants to go somewhere, near a beach, somewhere that's cooler. But Jason, apparently money's running out. I haven't seen this yet, but they're saying up to half of the people out there are canceling vacations because all of a sudden they just can't afford it. I got nothing, Jason. I got nothing. Are we there? No, still not there yet. We're working on it. Okay, so Jason is offline yet. We'll get it worked out. But, yeah, we'll see what happens. It's going to be interesting. We got some economic data we got to talk about today. I'll say not good economic data for those that don't want more rate hikes. Then an update, Janet Yellen. We really need to watch what's going to happen with the Treasury. Janet Yellen, the head of the Treasury right now, the Treasury still trying to reload, right? So after the debt ceiling, the emergency, already the debt now, we rolled over $32 trillion. Now we're at $32.1 trillion and change. Between now and September, hundreds of billions of more dollars need to be added. So we're going to be somewhere approaching, on the wrong side of $32 trillion. In other words, hey, we're going to round up to $33 trillion. Of course, before this year is over, $34 trillion and probably rising more from there as well. But it is an issuance problem. We're going to talk about that. What is Janet Yellen going to do? Because the amount of marketable treasuries that has to be rolled over. So I didn't know, you don't know when you're going to get there, but the rule of thumb is once you have more than 20% of the money, of the debt, marketable. Okay, so this is not stuff in Social Security. This isn't the stuff on the Fed's balance sheet, wink, wink, nod, nod. There's going to be trouble. And what the Treasury has been doing has been selling tons of extremely short-dated treasuries. To give you an example, just this week, $160 billion, $162 billion, I'm sorry, did I say week? Oh, shame on me. In one day. $162 billion of treasuries needed to be rolled over. So that was, hey, we've got new debt and then existing debt. $58 billion of that was in 6-month bills. $62 billion of it was in 3-month bills. I mean, so 120 of the $162 billion was in 6 months or less. But what's even more interesting about that is the other $42 billion, that was in 2-year notes. And Jason, this is the problem now. Every day, the amount of debt that the Treasury has to sell gets bigger and bigger and bigger. And they're saying by the end of August, that they're going to have a big problem, that they're going to have to take a 6-month bill as an example. By the way, you know what they paid for that? 5.45%. Yeah, right? A 10-year note pays 3.7, or you can say, well, how about 6 months instead, and it'll give you 5.45. It doesn't take a rocket scientist to figure this out. Jason, get ready for the 10-year note to start rising, even if, now the Fed we think is going to raise rates. Let's not kid ourselves, but they may, whether they raise it once, twice, whatever it may be. But right now, a 10-year note's at 3.7. A 6-month note's at 5.45. They are not going to be able, come by the end of August, to sell all of these short-term debts. It'll be too much. They need to get the number down. They're rolling over too much debt every day. And they're like, oh my gosh, we're going to have 20% of marketable treasuries that got to be sold in a month, right? So think about that. That's what 4, 5. Well, actually, approaching 6? Well, the marketable. So you got to be careful because they always use marketable, non-marketable. But you're talking about rolling over trillions of dollars of debt every single month. And the only way to stop that is by saying, okay, we're not going to sell 6-month bills. Instead, we've got to sell $60 billion in 10-year bills. Jason, that is going to cause the 10-year note to skyrocket. So I think everything's good with Jason. We're going to have Jason back. We're going to talk more about it on the other side. Eight 800-951-0592. Joe and Jason, Patriot Radio News Hour. Quick look here at the markets. The Dow is up today. It's been a while since we've been able to say that. The Dow is up 100. The S&P's up 18. The NASDAQ is up 60. Gold is down 9. And I'm going to tell you right now, this is a sweet spot. We've been in a sweet spot. The calm before the next storm. And we're putting the dots together today. It's a little complicated, but by the end of the show, I think we'll have explained it to you so everyone's going to understand what is going to happen come the end of August. Silver is up today, up 11 cents. $22.95. Listen, if you're sitting there going, man, this can't work. Come on, man. Right? 32 trillion. I mean, think about this. What was it? 3 weeks ago? 2 weeks ago? They said the deficit was 31.4. Now we're at 32.12. And by the end of by the end of August, we're going to be over 32.5 trillion. And before the end of the year, we're probably going to be closer, and maybe, you know what, it just depends. Real close to 34 trillion before the end of the year. That doesn't count what the Fed's going to do. And if you're like, man, I don't like this, I don't see how this works out well, I'm telling you right now, look for the 10-year note. Look for interest rates on the 10-year note to continue to go higher and higher than most people are going to think. And we'll get to it in a minute, which you know is not great for equities. Goes back, man, Joey was saying it weeks ago. Hey, this thing ain't over. Rates are going to be a lot higher than people think, and you better be playing defense. Well, don't forget about our friends over at Y Refi. Up to 10.25% return, not correlated to stock market. It doesn't care. Doesn't care about Jay Powell. Doesn't care about Janet Yellen. Check them out. Invest, yrefi.com. That's the word invest, the letter Y, REFY.com, or just call them. 888-Y-REFI-24. Obviously, you guys know this. Got to have at least $50,000. That is the minimum. But I highly recommend you guys check those guys out. Now, kind of got a little complicated, a little muddy. But what they've been doing, and see, they do things like, I'll give you a great example. They're still taking oil out of the strategic oil reserve. They just don't announce it. Like we're not going to know. Now, it has helped keep oil prices down, hasn't it? Matter of fact, if you've noticed gasoline, I don't know why our gas was so damn expensive, but gas here was like $4.99. It's down to like $4.19. And like in the last like 2.5 weeks, we've gone from $4.99 to $4.19. I hope it keeps going low. I don't know why. But anyway, kind of robbing Peter to pay Paul, right? Shh, don't tell them. If we don't tell them, then they don't need to know. Well, this is what the Treasury, how have they kept the 10-year note so low? I mean, right, think about it. Right now, the Fed's funds rate is between 5 and 5.25. Okay, right? Well, a normal, healthy market, and this is normal like the last 50 years normal. The 10-year note would be yielding about 2 points above that. So let's call it set between 7 and 7.25. Right? That would be normally where the 10-year note should be. But it's at 3.7. How? Right, well, I just told you how, right? 6-month and 3-month bills, right, they're yielding almost 6%, 5.5%, 5.75%. And they're doing so much of it now. Every month, trillions and trillions of dollars need to be rolled over. And according to J.P. Morgan, by the way, all of this data, Wolf Richter, I just love this guy. He does some great research. wolfstreet.com is his website. I go there every day. Some days are better than others, just like everything else, but he does a lot of great research. And he was talking about, hey, there's this number, which I've never heard of before. But according to J.P. Morgan, once you get to the 20% level, when you have to roll over 20% of marketable treasuries, that's when it starts to get expensive. In other words, all the games that they've been playing with these short-dated rates and all this stuff, that's all well and good to try to keep that 10-year note down. And, of course, we know why they're trying to keep the 10-year note down. Because we know Wall Street hates a high-yielding 10-year note. The housing market hates a high-year 10-year note. Commercial real estate hates a higher 10-year note. And now because of what the bank's balance sheets, banks hate it. Normally, higher rates, higher 10-year notes are good for banks. But maybe not this time. And Jason, we're going to hit this level by the end of August. And what they're saying is going to happen is the Treasury is going to be forced into loading up on longer-term debt. In other words, hey, we can't sell $150 billion a day of 3-month, 6-month, 1-year Treasury notes. We're going to have to put it in 10-year, 20-year, 30-year notes. And, of course, there's J.P. Morgan saying, listen, there's not enough demand. The rate on the 10-year note is going to start going much higher. Whether the Fed hikes rates or not, they're saying, hey, it won't matter. Get ready for a much higher 10-year note.
Yeah, the only way to achieve that goal is a higher interest rate on the 10-year note because, there's no demand, right, Joe? So if all the investors are going to keep buying the shorter term, you see interest rates just keep on going, right? Keep on going. So if the 10-year doesn't catch up, if it doesn't get to a higher level, no one's going to buy it. You just said banks are not liking it. Well, if it's going to sit where it's at, people, these institutions won't buy it. And then that means interest rates, I think will just keep climbing until that changes, Joe. The inverted yield curve is going to be bad for the cost of money. I mean, let's face it. Technically, they're still tapering, right? Taking stuff off their balance sheets. It's just a little tiny bit, but the whole point is they're not increasing. So I would say that 10-year note's it's got to come up, I guess, right, Joe? I mean, they have to force it up so that they can stop the burning that's getting ready to come. So we'll see, right? We'll see what happens. But if it stays low, interest rates, I think they'll just keep on. The Fed's funds rate will just keep going up.
Here is the interesting part. What they're saying is, I want to say Barclays, $600 billion increase in the amount of long-term treasuries between now and the end of the year. So you got to find – listen, they had plenty of people wanting to buy a 6-month note for 5.3%, right? Plenty of people. Yeah, I'll take that deal. Well, how about a 10-year note at 3.7? Yeah, no thanks. So we got to add $600 billion, and they're saying this is going to start in August. August, September, October, November, December. So 5 months, $600 billion. That's $120 billion more a month. Here's the problem. Guess what? In 2024, you're going to have to do another $1.7 trillion. So these are going to shift from, hey, we are selling short-dated. We've got to shift it to long-dated because we're over the 20% threshold. And, Jason, this is going to drive these longer-term rates much higher than the Fed hiking rates. Because, well, let's face it, the Fed has been hiking rates, and the 10-year note's been sitting around 3.7 for what? 4 or 5 rate hikes now?
Right.
Right?
Right. Well, the shorter term stuff is just more appetizing because everyone's unsure what's going to happen. So that's all that's going to be purchased. And if you need to get a lot of it sold, then obviously it's a lot more appealing if the interest rate is higher. So once again, Joe, nobody wants to take the risk of 10 years right now. Would you? I mean, I wouldn't. If I was putting those large amounts of money into these things, I think I'd be better with a 3 or 6 month to see what's happening. 10 years?
Right.
I don't know, 10 years doesn't look good to me.
Well, Bank of America is calling this what they're anticipating is a demand vacuum. Now, Jason's been talking about the reverse repo. And it started to go down a little. Of course, it's been going down because the Fed has been having to issue a lot more debt. But this, I think, is the draining event that we're not looking forward to. This won't be a great sign here, but Bank of America says they're anticipating a demand vacuum that will be resolved. It's real simple how this gets. It's so this is not. This part isn't complicated. How do you resolve it? Well, real simple. Raise the amount of interest you have to pay, and that's exactly what Bank of America is saying. The solution will be higher yields for longer maturing securities. Yield solves all demand problems. Boy, isn't that the truth? Isn't that the truth? And remember Janet Yellen, the lunch lady. I told you, the most evil woman in all of finance. That's my personal opinion, by the way. Go big. Remember her? Remember, go big. Let's load up on debt because it's cheap. Of course, I was saying, well, what happens when it's not cheap anymore? Then this morning, let's see, J.P. Morgan, Barclays, Bank of America, right? They're all saying the exact same thing. Hey, guys, I don't know if you guys know this or not, but we got a problem here. We're going to have to sell so much long-term debt. The only solution is skyrocketing. It's high. I mean, right now at 3.7. Let's just fast forward. Could you imagine let's say the end of the fiscal year? So by the end of October, could the 10-year note be yielding 5%? I mean, that would put a mortgage, right, about what, 8.5%, 30-year fix would be what, 8.5%, something like that?
So maybe better rush to get a home now, like those numbers that came out today?
I'm going to tell you right now. I hate to say it. I think housing it's going to get worse before it gets better. Right? There's not a lot of houses out there. No one can afford them, and I think it's going to get even less affordable. And that's not a good sign, right? But again, remember the commercial real estate. Let's focus on that for a minute. Every time those long maturity rates tick up, that means more property is ineligible to be refinanced, right? You just became ineligible, right? Your new payment puts you in the ineligible. You're not collecting enough rent to match what your new payment's going to be because remember, they only pay the interest. Jason, I think this is the nightmare scenario that a lot of people are anticipating that we don't see day to day because we don't pay attention to this stuff. We just see, hey, Jay Powell's pause. Maybe we're going to be careful. And we see a 10-year note at 3.7. It's been like 3.7 for most of the year. Now we kind of know why. And guess what? I guess everybody's saying get ready for the end of a low 10-year note. Patriot Radio News Hour. We'll be back after the break.